Welcome back. So we've considered the basics in understanding financial instruments. We've talked about several terms in IFRS 9. We've also looked at what led to IFRS 9. We've looked at the nature of financial instruments. We've also talked about the types of derivatives, and we've also looked at how to distinguish equity from liabilities. So what we want to do now is to look at one other important aspect of understanding the basics of financial instruments, which is focused on the measurement terms of financial instrument. You know, the way we have for IS2, where we talk about inventory measurements in terms of using the FIFO method, using the weighted average. So we're also looking at that of IFRS 9. So we are saying for IFRS 9, in order to measure our financial instrument, that is, in order to determine the value for our financial assets, our financial liabilities, our equity, there's an approach that IFRS 9 considers. And so that's what we'll be looking at now. So let's get started. All right, you take a pause and try this. You can come back to it later and you can also answer it now. So the question here says, a bond with a contractually stated principal of $1,000 was originally issued at $900. The current holder acquired the bond for $800. What is considered the principal? So you can leave your answers here or you can come back to it. Okay, so let's get started. So measuring financial instruments, there are key items that are considered when it comes to measuring financial instruments. So we have majorly three basic categories. If you remember the introduction to the IFRS 9 that we did mention the fact that under IAS 39 we had four categories, and then under IFRS 9 we have three categories. And so the three categories under IFRS 9 is what we'll be talking through, and we'll also be looking at examples that relate to each of them. So the first one is the amortized cost. The second one is what we call fair value through other comprehensive income, and the third one is what we call the fair value through profit or loss. Now, the reason why the third one is the fair value through profit or loss is because that is what we consider as the residual category, meaning that if amortized cost and fair value through OCI, if the financial instrument does not meet those two items, then it eventually always goes to the fair value through profit or loss. So we're looking at what each of these terms mean with respect to IFRS 9. Okay, let's get started with amortized cost. So what are the key features of amortized cost? That is, whenever you hear anything about amortized cost, what exactly does it mean? So for the purpose of this section, we'll be using AC to represent amortized cost. We'll be using FVTPL to represent fair value through profit or loss, and we're using FVTOCI to represent fair value through other comprehensive income. So for amortized cost, these are the key features of amortized cost. Basically, if you remember IS16, IS16 talks about depreciation using straight line method. So just the same way we have depreciation, we also have amortization. And if you remember IS38 that talks about intangible assets, it says that to depreciate under IS16, we depreciate a PPE, but intangible asset we amortize it. So if you bring that idea into IFRS 9, we say that financial assets and financial liabilities are also amortized anytime they fall into the category of amortization. And the way it works is the way normal amortization works. What we are doing is we are spreading the cost over a particular period of time. And that's why you see that the key feature here says to amortize means to spread. Okay, now one important aspect of this is to note that amortized cost relates solely and basically and essentially to just debt instruments. You know, we mentioned that we have derivatives, we have debt instruments, and we have investments in equity when it comes to financial assets. And for debt instruments, it is amortized cost only relates to debt instruments. You can't apply amortized cost to investment in equity. You can't apply amortized cost to so under financial assets. What we are saying is that both under financial assets and other financial liabilities, amortized cost relates only to debt instruments. Remember, a debt instrument can either be a financial asset or a financial liability, depending on the perspective at which you are looking at it. So when it comes to amortized cost, you can only apply amortized cost to debt instruments. Now, one thing that is certain when it comes to debt instruments is that for you to say you are using amortized cost, it has to be that the debt instruments have solely payment of principal and interest. Now, what that means is that if you have a loan that you have taken, the loan has the principal that are supposed to repay, and it also has attributed interest. Now, it's not compulsory that the interest has to have a percentage. So there are situations whereby there's no interest at all, which may be just zero interest. But the major thing is that it must not have anything outside principal and interest. If it has anything outside principal and interest, then it does not meet the requirement to be categorized under amortized cost. So we are saying that what are the features of amortized cost? That is, what are those requirements for a financial asset or a financial liability to be measured using amortized cost? So for amortized cost, it is only debt instruments that are either financial assets or financial liabilities that are categorized under amortized cost. And those debt instruments must have solely payment of principal and interest. Once it checks these boxes, then you can actually apply amortized cost to them. An example of a debt instrument that will not fall under amortized cost is, for example, where you have a loan that you have taken and the interest on that loan is linked to an equity index. Now, the equity index is no longer just principal and interest alone. The interest is no longer a normal interest. The interest is tied to something else, and because of that, it won't be categorized under amortized cost. You can't use amortized cost to measure it because it no longer has a characteristics of a normal or basic lending interest, and so you use fair value through profit or loss for that. Remember, we said that once you can categorize something as amortized cost or fair value through other comprehensive income, you categorize it by default as fair value through profit or loss. Now, another item is that amortized cost represents the original cost of the asset plus any interest income earned over time minus any principal repayment and loss allowance. So what that means is that when it comes to amortized cost, there is a step that is taken, and the step is such that the opening balance will be the principal amount, then what grows that opening balance is the interest that is added to it, and what reduces that opening balance is the principal repayment that you make, and then whatsoever you have left is your amortized cost. Now, you can have a gross carrying amount for your amortized cost, and you can also have a net carrying amount. Now, the essence of that is that the closing balance that you have, by the time you remove loss allowance is the ECL, the expected credit loss impairment test that you carry out on your financial assets carrying amount. So when you make that calculation and you deduct it from your carrying amount, whatever you have left is your net carrying amount. And that's the essence of what this aspect is saying, that an amortized cost represents the opening balance, which is the cost of the asset, plus any interest income that accrues on it, and any repayments that reduces it, and when you now subtract a loss allowance, you have your closing balance. So that's pretty much how amortized cost work. Now, with respect to the interest part of it, the interest can be an interest expense or an interest income, depending on the perspective you are looking at it. So if what you have is a financial asset, then it means that you're expecting cash flows from the other party. So for example, where you are the one that actually gave out loan to somebody, what you have is a financial asset, while the other person has a financial liability. So that implies that the other party will be paying you interest income, while the other party will be incurring interest expense. So to you, your own amortized cost will be showing an opening balance plus interest income less any principal repayment that you collect, while the other party will be having an opening balance plus interest expense, then less any repayment that the other party has made. And that's why you see that we have an interturn between interest income, and I've also been talking about interest expense, because we said the debt instrument that we are dealing with here could be a financial asset or a financial liability. Now, when it comes to calculating the interest income, what we always use is the effective interest rate. Now, the reason for using effective interest rate is because there are some transactions where you do have, for example, where you've given out a loan, but there's a particular transaction cost that you charge the other party that is taking that loan from you. We always factor that in the calculation of our amortized cost. By the time you're taking the advanced class where we delve into classification and measurement, you will see a whole lot of calculations with respect to that, where we'll be drawing up computations for different aspects of amortized cost. And so the essence of this is to just introduce you to the workings behind amortized cost so that you have a basic understanding of how it works and you can have conversations around that. So examples of amortized cost or examples of debt instruments that we can actually apply amortized cost to are, for example, trade receivables. Trade receivables, as simple as it looks, there are situations whereby a trade receivable can actually have a significant financing component. That is, the repayment period of that trade receivables is more than a year, and as a result of that, you even collect interest for the delay in payment by your customer. Same as loans that we mentioned, bonds, fixed deposits with banks, all these are debt instruments that could be financial assets or financial liability depending on the perspective of the holder or issuer that you're looking at it from. And then what we do is we apply amortized cost, meaning we start with the opening balance, we increase it by the interest income or expense, and we reduce it by the principal repayment, and then now let off the loss allowance. So let's take an example to see how this applies. Okay, so the illustration here says that on 1 January 2022, you took a bullet loan of $5,000 from your bank with an agreement to pay back over 3 years. The loan has a fixed interest rate of 10% that is paid annually. Your bank has no intention to sell the loan to another party. And so in this case, what you took is a bullet loan. Now, when you say a bullet loan, bullet not in terms of, you know what I'm talking about. Now, bullet basically means that the principal repayment is made at the maturity of the instrument. That is, it is at the end of the, so for example, in a situation whereby you have a loan period of 5 years, the principal will be paid on the 5th year, but you keep paying interest year in, year out, but the principal itself will be paid in full, that is as a single payment at the end of the loan period. So that's what bullet means. So here is asking us to draw out an amortization table that addresses this scenario. So remember, on 1 January 2022, you took a loan of $5,000, which is for 3 years, and the loan has a fixed interest rate of 10% that is paid annually. Your bank has no intention to sell the loan to another party. So how do you treat this on an amortization table? So what I've done is to include an Excel sheet that shows the calculation and also the adjusting entries. But for the purpose of this, I'll just show you a table that describes how these entries looks like. So how should your bank record this transaction? So we are looking at this from the perspective of the bank that gave out the loan to the customer. Okay, so we have established that the year is for 3 years, which is from year 2022 to year 2024. Like we mentioned, the opening balance is that $5,000, which is what we have here. The interest income is the percentage on the opening balance. And if you look at what we have here, we have 10% of 5,000, which is 500. Then the next one is now the interest received, which is the repayment. You know, we mentioned that the way amortized cost works is that you have the opening balance, then you have the accrual of interest on it, which increases it. Then we now have the repayment of both the interest and principal. Then before we now have our closing balance. If you look at what we have here, the interest of 10% is applied to 5,000, and that gives us 500. And because the actual interest received from the customer is also 500, so we have that 500 there as well. Because we said it is a bullet loan, it means that the 5,000 will be paid at the end of the period, and so that's why you see that this column D is dashed, nothing is there. Then our closing balance as at year 2022 will be the 5,000 plus 500 minus 500 that was paid, and then we have a closing balance of 5,000. Now the reason for this is because the repayment of the principal is on the third year. That is, you are not paying the principal gradually, you are paying it in a bullet. So if you move to 2023, it does the same calculation, and then until the third year when full payment is made and everything becomes zero. So what I've done is to include on the first row the calculation that relates to each of them. So you see I've labeled them as A, B, C, D, and then we are saying that the closing is A plus B minus C minus D, which is the same as what we have discussed earlier with respect to how amortized cost works. This is a basic example, and it's just to show you how amortized cost work. So next time when they mention that, oh, this particular financial asset or financial liability will be measured using amortized cost, you already know the key features that makes it possible for us to apply amortized cost, and you also understand that this is how the table looks like. And if you have to pass any adjusting entries, you will see that in the next slide. And so here what we have here is that on 1st January, when the bank gave out that loan, what we have is a debit of 5,000 and a credit of 5,000. So this is meant to be 5,000, 5,000. So a debit of 5,000, a credit of 5,000, which is to record the loan given out to the customer. Okay, so as at December, what happens is that the interest income goes into profit or loss. And so what you notice is that we debit cash and we credit the interest income. Now, the interest income that we are crediting indicates that we are receiving cash of 500 from the customer, and we're also taking the interest income to profit or loss. Now, if you look at the reconciliation here, the reconciliation just shows how the movement works from January to the end of the first year, which is the loan to customer is 5,000, there's an interest income of 500, there's an interest received of 500, principal is 0, and the closing is 5,000. So at the end of it all, the additional adjusting entries that we may have had, which have already combined into this 31st December adjustment, is to have said that when cash was received, we debited cash and we credited interest received, which is reducing our loan to customer. Same thing for interest income. When we recognize the interest income, we would have credited interest income and we have increased our loan to customer, which would have debited this 500. So at the end of it all, these two guys nails out and we have 5,000 as our closing balance. So that's pretty much how amortized costs work. If you'll be taking the advanced course for classification and measurement, where we'll dive deep into a whole lot of complex transactions that has to do with amortized costs, you will see how to better apply this in practice.